Hello, my name is Brant Steck. I'm Vice President at BUI, and welcome to another edition of Hours and Minutes, where we provide hours worth of information in just a few minutes. With me today is Michael Tessler. Michael is BUI's president, and today we're talking about life settlements. So, Michael, there are a lot of folks out there who have existing permanent life insurance policies, and maybe the need has changed. They bought it for income replacement, and now they're nearing retirement, or their kids are grown and out of the house, or they no longer have an appetite to pay the premium, or maybe they can't pay the premium anymore. What kind of options does a person like that have?
Well, great question, Brant. Obviously, the first option is that they could surrender the policy and take whatever cash value the insurance company has for them. But a lot of advisors contact us about ways to leverage that policy, and one of them is to use the funds in the existing policy by way of a 1035 exchange to purchase a hybrid life insurance policy with a long-term care rider, because for many of those folks, the need that's much more on their mind today is in fact long-term care, especially the ones you described, nearing retirement, kids are grown, that sort of thing. So that's an excellent opportunity for a lot of these folks. But if they've already addressed their long-term care needs and they're still looking to maximize the value of the policy, another option may be to sell or settle the policy for an amount greater than the cash surrender value.
So when we're talking about permanent policies, is there a certain type of permanent product that is more attractive to a buyer than others?
Yeah, generally speaking, universal life insurance policies are most attractive to those who are purchasing policies. It's not to say that they wouldn't buy a whole life or a variable life policy, but universal life is the one that is of the greatest interest to them and generally garners the greatest settlement value.
Got it. And where does term insurance come into play, if at all?
Term insurance can be sold as well. Usually it would require that the term plan still be within the conversion period. Most funders, after they purchase a term plan, are going to convert it. But term insurance plans are absolutely sellable.
So for a client who is maybe over age 65, health not so great, short mortality, that term insurance plan could be an attractive asset. It could be something of real value.
Clearly it can, and surely they should explore whether they should sell the policy in the first place with their financial advisor and make sure that they understand the financial ramifications.
Sure. So when we're talking about selling a policy, I think a lot of people think of viatical settlements. Can you touch on what the difference is between a life settlement and a viatical settlement?
That really comes down to life expectancy. A viatical settlement usually refers to the selling of a policy where the person who's insured has 2 years or less of life expectancy. A settlement usually is for somebody who has greater than 2 years, but less than 12 years. And that's really the big difference between the two.
Got it. So somebody who is potentially selling a policy, let's say we have an advisor has a client and they're selling a $5 million policy. Should that person be worried about having a target on their back? Do they have to look in the bushes before they enter their house?
That's a topic that does come up pretty often, but based on experience, the answer is no. The buyers of these are generally institutional. In fact, interestingly enough, frequently it's insurance companies who end up buying settlements. They're buying the policies from other companies. Another big investor are European mutual funds. Usually what happens with these is that bunches of life settlement cases are all rolled together into a tranche that's sold into the investment market to institutional buyers. I'm not aware of anybody selling policies to some Colombian cartel or anything like that where they would need to be concerned about having a target on their back.
Got it. Okay, so the client who is has come to the conclusion with their financial advisor that this is an asset that no longer makes sense for them. What other factors might that person have that makes them a good candidate for a settlement? What do they look like?
Generally speaking, you're talking about somebody who's at least 65 years old or older, has had a change in health since they bought the original policy, and not usually a small change, but a more significant change in health since they bought the policy. As you mentioned, they've determined with their financial advisor that they absolutely don't need that policy anymore. And usually we're talking about policies with a death benefit of at least $250,000. There are buyers who will buy for less policies with less than $250,000, but you should expect that the offer will be impacted if it's a smaller death benefit.
Got it. So we have the needs there. We know what the candidate looks like. If someone were to want to explore this, what does the process look like?
It's actually pretty simple. It starts with a 1 or 2 page questionnaire that gets us some of the general information about the client's health, the ownership of the policy, things like that, accompanied with a in-force ledger that shows the necessary amount of premium to get the policy to age 100. With those 2 things in hand, the settlement provider will review that data and determine if it's even worth it to move forward. Assuming that it is, the entire process is really not too difficult for the client, as there's no exams. It's all handled by obtaining medical records and other data. And then it's going to go out to life expectancy companies. These are professional companies that are going to determine, based on that data, how long that person's expected to live. Most funders get at least 3. And if they do get 3, they'll get one that says this person's got a 60-month life expectancy. Another one says it's 70 months. And another one says it's 80 months. And usually they'll use the average of the 3. In my example, that would be 70 months of life expectancy. Combine that with the policy performance to determine how much they'd be willing to pay for the policy.
Got it. So just kind of bringing things full circle and bringing it together. If an advisor and their client come to the conclusion that a life insurance policy is no longer needed for the purpose of the death benefit, if the client's 65 or under, they may want to explore surrendering the policy or doing a 1035 exchange into a plan that might have a long-term care benefit. If they're over 65 with a life expectancy under 12 years, they may be a very good candidate for a life settlement.
That's well done. And I will tell you, we get calls from advisors all the time because their 50-year-old perfectly healthy client saw an advertisement on TV that says they can sell their life insurance policy. And I can tell you, there is no market for a 50-year-old super healthy person to sell a life policy.
Got it. Well, good information. Thank you.
Thank you.
Anyone who might be interested in exploring a life settlement can contact Michael or myself, or if you have questions for future Hours and Minutes, email marketing@buiusa.com.